Hey, welcome back to the show. And joining us today is Jim Bianco, the president and founder of Bianco Research, an independent research firm providing objective, data-driven insights into global economies and financial markets. Jim, it's an honor to have you on the show today. How you been?
I've been very good. I'm getting over a cold, so hopefully I don't sound too raspy, but feeling better than I did a couple of days ago.
Well, it's definitely going around. That's for sure. Perhaps you could start off providing your high level overview as it relates to financial markets, global economy, geopolitics, just kind of broad stroke. What's going on in the world? What should people be paying attention to?
I think a couple of things. I always start off whenever I have these kind of questions with, I think it's a post-COVID economy. And I think that is actually more relevant the week we're recording than it's been because people are starting to argue that there isn't a post-COVID economy. In other words, what a post-COVID economy means is that we had a recession and a financial crisis in 2020. Every time we have one of those, the economy changes. And I'm always careful to say, I didn't say it's worse. I didn't say it's dystopian. I said it's different. And there's nothing wrong with it being different, but it's not the 2019 economy. It is not an economy of sub 2% inflation, and a jobless recovery, which is what we used to have before, and that the appropriate thing was zero interest rates and a Fed that was constantly expanding its balance sheet. We have an economy that is now in the middle of a big change in immigration, a big change in the way we work, remote work being the higher thing of that, and a big change in globalization. We are deglobalizing, and the highlight of that is tariffs. That means that we are in a stickier inflation world. 6 years, we are now 6 years after the start of COVID. And we're just getting to 2.4% inflation. Everybody's saying, oh, thank God we're getting back to normal. What was the last 6 years? Well, the last 6 years, we've averaged over 4% inflation. That was normal. We're actually at the lower end of that number right now. That doesn't mean it's worse. It just means it's a very different type of economy. So so the high level is, I do think it is a post-COVID economy. It's one of much faster growth. It's one of much higher inflation. It's one of much higher interest rates. I know the president and the Federal Reserve want to try and pretend we could go back to zero interest rates again, or 1% as the president has been arguing. But that's not the environment we're in anymore. As far as financial markets go, I think there's been a big rotation in financial markets to twofold. One, at the bigger picture, I call it the 4, 5, 6 markets. That over the next several years, and this is more on the lines of expectations, cash should return you around 4%. Now, I know the funds rate, as we're talking, is 350 to 375. It's a little below that. I don't think the Fed should cut rates anymore. Whether they should hike rates, I'm not ready to go there, but let's just start with they should not cut rates anymore. That over the next several years, if that's the case, cash should return you around 4. It's returned a little bit above that, in 2024 and 2025. Bonds should return you around 5%, and stocks should return you around 6%. Well, going back to my post-COVID economy arguments, if we're in a 3% inflation world, and I think we are, I don't think we're in anything worse like 8-10 of Zimbabwe inflation, a 3% inflation world, 4, 5, and 6 are actually pretty good numbers. You're getting a real return. You're covering more than covering the inflation rate. Now, the reason I say that is a lot of people look at 6. What do you mean 6? The stock market's supposed to give me 20. I'm supposed to be able to buy SPY, the S&P 500 index, and as long as I keep breathing, I'm owed a 20% return. And then I'm supposed to look for good ideas to give me a 50% return on top of that. Those were outsized years. And I think that as we go forward, 4, 5, 6 is not bad. It just sounds disappointing because we've gotten used to outsized type of returns. Within the market, I think there is a big rotation. And that rotation is away from software and some tech and towards value, small cap, international, and the like. A lot of things that were left for dead. I heard a statistic earlier today. Small cap international stocks. I've forgotten that there was actually a group, small cap international stocks. That's how out of favor they were. They've actually now outperformed the NASDAQ 100 for the last 5 years. That's how well those stocks have been performing. What's driving that? I would argue it's AI. And why do I think it's AI? Because what is AI disrupting right now? Software. The cost of software is collapsing to zero. The reason you use a company like Salesforce for a customer relations monitor or CRM or Bloomberg, and you pay, in the case of Bloomberg, because we're talking financial here, $3,000 a month for their product, or Salesforce, you pay hundreds of dollars a year per seat for their product, is billions of dollars and millions of man hours have gone into creating that software. And it's reliable and it's dependable, and they constantly have staffs of thousands that keep it working properly. And that's why it's so expensive. What's happening with AI is it's collapsing the cost of that software practically down to zero. So not only would a Bloomberg be able to keep its software going, or a Salesforce for practically zero, startup competitors can recreate their software for very little. And there are thousands of things I would like to do with software that we don't do, because in order to have it done would have taken armies of software engineers, millions and millions of dollars, and months of planning and preparation to do. And that's now changing down to not much money in weeks. So what has happened is, if you look at the SG&A, the selling and administrative costs of a lot of businesses in America, a lot of their costs are software. And a lot of their other costs are because they don't have software to do it. So if we're going to collapse the cost of software, that hurts Silicon Valley, because they've got a pricing model that is based on price per seat, hundreds if not thousands of dollars a year. And that might go down to $50 a month or $100 a month, and not thousands of dollars a year or something like that, or maybe even less. And hundreds and thousands of new software applications are coming. And all of these companies that spend all of this money on taxes, on compliance, on administration, on accounting, are going to find that all of that can now be done for pennies. And that is going to massively increase their margins. That's why I think that those companies are rallying now, and the software companies are being hurt. The software companies are not going out of business. It's their growth models are changing, and that their opportunity sets are changing, and the beneficiaries are going to be me and you and everybody else that pays for software. The payments we're going to have in the future is going to be pennies of what we're paying right now. So that's what I see as being the big driver, AI driving down the cost of software. Everything I do, everything you do, is going to be reduced to a cheap software program that will do it for us and relieve us of that. So that's my big picture of how I'm kind of attacking the world.
Yeah, that's I had not previously been really tracking that too much, but that is a very interesting wrinkle to dive into as far as it relates to the big picture goes. How about, I know typically, you cover financial markets, et cetera, but anything even outside of the U.S., like geopolitics, that you care to comment on, and how that might impact the financial markets, things that you're tracking, even society?
I think that if you look at Western civilization, or the West, the developed world, let me define that a little more directly. You're seeing an interesting pattern among all these countries, and the pattern is around immigration. Immigration, or migration, as they call it in Europe, is probably the defining political issue that we have right now. We see it in the U.S. because we've elected a president who's taking a strong stance on immigration. What we see in Europe is we see a lot of European governments are still progressive left of center governments that are pro-immigration, but their populaces are now telling pollsters that they're going to vote for what they refer to as the far right. That's supposed to be a pejorative in Europe, but it really isn't anymore. But they're going to vote the right-wing governments in that are going to crack down on immigration. So what Trump is doing in the U.S. the European population is saying, we want that to happen here. Maybe they don't want a Minnesota, but they want a crackdown in immigration. Now, where does that come in with financial markets? The day we're recording on February 18th, an exclusive popped up in the Financial Times that Christine Lagarde, who is the president of the European Central Bank and has been there since 2019, and her term ends in October of 2027, said that she's going to retire or resign or step down early. Now, when asked why is she going to step down early, they stated it up front that Macron and Merz, Macron being the president of France and Merz the chancellor of Germany, would be the primary people to pick the next ECB chairman. But it looks like the right-wing government's going to win. The right-wing party's going to win in France. That would be the National Rally Party headed by Marine Le Pen. And she doesn't want the right-wing party to appoint her successor. So it's not unlike a Supreme Court justice in the United States saying, ooh, I better step down now. Why? My party is still the president of my political lingo. So if I'm a liberal justice, I'll step down when there's a Democrat in charge. If I'm a conservative justice, I'll step down when there's a Republican in charge so they can replace me with a like-minded person. So it's almost like Christine Lagarde is already admitting that we're going to see a big change in who's going to get voted in the governments in Europe. In the UK, Keir Starmer, who is the Labour Party prime minister, looks like he's not going to make it to the end of the year, and it looks like he's going to get replaced by a conservative or a Tory or maybe some other new kind of right of center party. And it's all of this is driven by immigration right now. It's all been driven by the opening of the border, letting everybody in. We let too many people in. Now we want to try and reverse it. That is the overriding politic of the developed world right now.
Yeah, it's been fascinating to watch and track, and also alarming a lot of the stuff that I've been hearing about overseas, particularly over in UK and in continental Europe, and the impacts that'll have. As far as if there is like a regime change over in Iran, can you expand perhaps how that might impact the markets and what we would see in trends, et cetera?
Well, I think at least initially, if it looks like there's going to be some kind of response by the administration, right? So the Trump administration is engaging in discussions or negotiations with the Iranians. The consensus, at least as I understand it, is it's not going to go anywhere. And so they'll say, look, we tried. And then there'll be a kinetic response, to put it, mildly. And the kinetic response will be focused on regime change. Now, the markets will probably treat this poorly initially because our record being in the West of trying to effectuate regime change is pretty poor. We usually go in, try to effect a regime change, and we wind up making it worse, not better. Because, you thought the guy we got rid of is bad. Wait do you see the guy that's coming in to replace him? And that's a well-founded argument. Whether that winds up being the case again in Iran, maybe it doesn't, but I think the market's initial response is going to be that it won't be, that it will be disruptive, and it will, and we've already started to see that. The day before we're recording, as the Iranians were negotiating with the U.S., they fired a bunch of missiles into the Strait of Hormuz. They just fired them and they landed in the water and didn't bother anybody. But it was just like, I just want to remind you, we have these things and we can do this in the Strait of Hormuz, which is where 1/3 of all of oil shipments are going in. Oil tankers go in and out of the Persian Gulf through the Strait of Hormuz. And so, just a reminder, and that if there is going to be a regime change, that there's going to be big disruption in the oil markets right away. And so that's why I think that we've seen the price of oil going up. And we've seen, some nervousness in markets about that right now. But I do think that if that does happen, I'll be like everybody else. I'll hope that if there is a regime change, that it does work out for the best. It's obvious that the Iranian people want it because they've been protesting in the streets for it. But we'll fear the worst, that, we'll just wind up making it worse than it was before, like we've done every other time we've tried it everywhere we've ever tried it.
Yeah, we certainly don't want to see an Iraq 2.0, if you will, and some, or a fill in the blank, a lot of these other events. Wanted to segue to some of the notes that I took. I know I kind of shared with you prior to recording, I should say, just to get a little more granular as it relates to the markets. You had mentioned that you're bearish on China, and I'd love to hear your commentary on that.
So I think that China has made a number of mistakes, and I think it's going to be very difficult to recover from them as they're currently restructured. So, first of all, on a statistical standpoint, China is reporting 5% growth. Now, don't compare that to the U.S. 5% GDP growth in the U.S. would be mind-blowing. But compare it to China itself. And remember two things. First of all, if you take out all of the volatility around COVID and zero COVID, 5% growth would be a 50-year low. And also remember that those numbers are largely massaged by the communist government themselves. So the communist government is giving you made-up numbers that say that they're already at 50-year lows, leaving the COVID shutdown out of there. So that's alarming in and of itself, that at least if you're going to make up numbers, you could do a better job than that as well. Now, the reason I think that they're in that position is Xi has been the president of China now for about 18 years, and he's a very authoritative person. We're back to kind of some kind of criminology with China. Who is in the head of the military, and how many of there's these pictures of the guys with the red X's that have been removed from their positions, like the top 10 military leaders in China. 8 of them have been removed now and have disappeared. There's been a number of other types of things too, with the takeover of Hong Kong and the like. We are in a period of change, creative destruction. An authoritarian government is not in the business of shepherding through epic change, because they don't know what's coming next. Neither do we. And that's why it's so difficult. What China is good at is what they've always been good at, is taking what everybody else has invented and doing it cheaper and faster. That's it. So their manufacturing processes and some other things, those are already established processes. They're just going to do them cheaper and faster. Okay, that's fine, but that's not going to be enough for them. On top of that, they have probably made the single biggest error of any government in human history, and that was their their one-child policy. So from the late 1970s, 2016, the country had a one-child policy, and it worked. That they changed the culture about having children, so that China's population is actually contracting. And their population contracting means now that last year, India actually passed them as the most populous country in the world. So they're number 2, and they're going down in population. Why is that a problem? They've got 2 huge problems in China. One, something like 59% of the children that were born under one-child policy are male, because everybody wanted to have a boy if you're going to have one. That means that there is not enough women to go around for men. So you've got a bunch of men that would like to meet women. I'm not even saying get married and have kids, but there ain't enough women. And so that is not a good cocktail. Also, because of the one-child policy, you're getting a top-heavy population. Too many old people, not enough younger people. That has also been a real problem. They've also made some horrible political decisions along the way with their ghost cities. So China has built all of these cities, these ghost cities, where they are literally cities that are unoccupied, built to hold millions of people. Big apartment towers, center business districts, empty. Millions and millions of Chinese people have bought these condominiums and homes in these ghost cities. the idea was eventually all the people from the countryside would come to the cities and populate the cities. But because of the one-child policy and everything else, it never happened. So they're all sitting on this unsellable real estate. And they don't want everybody in the country to wind up taking losses, because a lot of people put their life savings, their retirement, into this 2-bedroom condo they bought in some city that's supposed to have 2 million in population that nobody lives in right now. They can't sell it. So they're trying to massage their way out of these population or out of this problem. And they've got a gigantic banking problem with this, because the banks that have extended all these mortgages, nobody's paying on these mortgages. They're not foreclosing on them because they don't know what they're supposed to do with this property if they foreclose on them. So they've got a brewing financial problem that they're trying to get themselves on. These are big problems. These are big problems that don't necessarily mean China is terminal, but in order to fix it, what China has to do is they've got to probably get to be more open, allow more creative destruction, allow write-offs, allow a restructuring of society. And if you're an authoritarian government, you want none of that. And that's why I think that they've got more upheaval ahead than they've got other things going. Two things can be true at the same time. One, China can be the preeminent manufacturer of the world. Give them a process to make something, a car or a blender. I'm just making up something. And they'll do it very well, and they'll do it very cheaply. But also tell them that they need to evolve. They need to change their population mix and everything else under an authoritarian government. They're incapable of doing that. And that's going to be a very big problem for them at the same time.
Regarding other countries that perhaps you care to share any commentary on, are there others, whether in Asia, Middle East? I think Dubai comes to mind, parts of Europe, et cetera, that are along the same lines, or even more in inverse that you're bullish on?
Yeah, and let's talk inverse. Japan. What I described as China, you could say was Japan 30 years ago. It was old. It was oligarchic. I know it's a strong word. In other words, was unwilling to want to change. The famous statistic I've cited was from 2004 in the Economist magazine. They listed the top 20 electronics firms in Japan in 2004. They then listed the top 20 electronics firms in Japan from 1954 and 50 years earlier. And 19 of the 20 names were the same. Nothing changed. That ain't the case here in the United States or anywhere else. There's that creative destruction, that new companies come, old companies merge, or they die. Some of the older companies do make the list and stuff like that. But nothing ever changed in Japan. So for 30 years, from 1990 to about 2020, Japan was stagnant. It went nowhere. But now, finally, after a generation of upheaval and change, it seems to be emerging. Growth is appearing in Japan. Deflation is no longer the case. Their stock market finally took out its 1990 high within the last year or so. Their interest rates are going up. For the first time since the 1970s, Japan actually has a higher inflation rate than the United States. That's actually, in this case, that's not a bad thing, because they were suffering with deflation before. But to have 3-ish% inflation, that's what I'm talking about, when we have about 2.4, 2.5, that's actually not a bad thing for them to have, because it means their economy is finally making forward progress where it was kind of stuck in the mud for a generation. So what I described in China, I think it was Japan 30 years ago. Japan went through a lot of upheaval. If you've followed any of Japan's politics, they were turning over prime ministers like Italy turns over prime ministers. Every other year, they had new prime ministers. The Diet, their Congress, if you will. There was fistfights on the floor of their Diet because the change was so difficult to make that it was a very serious thing that you'd see members of the Diet physically fighting with each other on the floor. Take that as a sign that it was a big deal to these. It wasn't just congressmen who were just getting, that just were lifers that would just vote along to get along. They went well beyond that. So Japan is kind of on the upside. And their stock market has been a stellar performer, and their economy is showing more signs of life. I know the latest quarter was a bit of a disappointment, but it's uneven there. But it is definitely showing signs of life. So on the flip side, I'd say Japan is definitely one of them. Now, the biggest concern you'd have with Japan is their interest rates are soaring because they finally have some growth. They've got some inflation. They can get their interest rates that have been stuck on zero for at least two decades off of zero, and they're going up. And the concern always is that when interest rates rapidly rise, you could break something. And what that means is that their financial system might be structured on the idea that they have low, stable interest rates. Now they've got high, volatile interest rates, and an over-levered financial system to low, stable interest rates might not be able to handle that. And so there's always a risk that there can be a financial accident in Japan. And even if there is, it's part of the process of getting out of that stagnation. And I would see that as being part of a process. Yeah, it'll be painful. It'll be destabilizing to the financial markets. But if they are really recovering, they'll get past it eventually.
Fascinating to hear your thoughts on that. Yeah, Japan. I feel like you've been hearing quite a bit about Japan, and and the carry trade, as well as the population.
I was just going to say the carry trade. The whole idea of the carry trade was in Japan, interest rates were stuck at zero. So what the carry trade was borrow money in Japan from a Japanese bank at zero, then convert that money to another currency, and buy something with a yield somewhere else. But since their economy was stagnant, the rates were at zero, you could take the currency risk because the yen never moved. So the popular carry trade was, for many, many years, borrow a lot of money in Japan at zero, convert it to Mexican pesos, and buy 3-month Mexican T-bills at 10% interest rates. And then you pocket 10% a year. The currency hardly moved. Well, what's changed now is interest rates are going up. The currency is very volatile, and Mexican T-bill rates are falling from 10 to nearly 6 at this point, and that trade has been unwinding very painfully and stuff. And that's a signal that we're leaving that old era, zero interest rates, stable, zero interest rates, stagnant economy, dormant forex market, to something else is what we're doing with Japan.
Well, I appreciate you unpacking that a bit, I should say, and very, very interesting here. And then I'm looking at my notes here. Another comment I wanted to ask about was in regards to you mentioned, I have down the decline of the U.S. dollar is attributed to rising interest rate in other countries, making their currencies more attractive rather than signaling the end of American exceptionalism or dollar debasement. We hear a lot about a lot of doom and gloom stuff, and perhaps you can touch on that briefly.
I think the dollar's been falling. The dollar index is its lowest level since 2022. And I'm in the camp that the dollar could continue to fall. Okay, fine. It goes down, it goes up. And it's going to go down for a little while more. But what I detest is it was called the end of American exceptionalism last year, and it's called the dollar debasement now. And I'll be blunt. That's a bunch of uppity Europeans that want to see us fail. Let's talk about the end of American exceptionalism. What is that? That was from Tocqueville's book, Democracy in America, that was written in 1835, where he called America exceptional. Now, in 1835, exceptional meant unique or different. Today, in 2026, to say that America is exceptional, a bunch of Europeans get uppity because they think it means morally superior. That's not what the word meant. So they like to say the end of American exceptionalism, that you're no longer morally superior. You know what you're saying is the country's going to cease to exist. The dollar could go up, the dollar could go down, but you don't have to tell me the country's going to end, because that's what you're doing. The dollar debasement trade, the dollar's going to stop being the reserve currency. I'm one that's made cases of where the dollar could become no longer the reserve currency, but where I've never made the case is it'll be another fiat that'll take over. It might be a digital currency, a crypto that could replace the dollar as the reserve currency, but Bitcoin or Ethereum or any of them are many, many years away from even thinking that that could happen. It's not out of the question. It's just not on the immediate horizon. So the dollar debasement theory is, the dollar debasement trade is this the end of the dollar as the reserve currency. We're going a little much with this. And again, I think it's a bunch of uppity Europeans that just want to see us knock down a peg. Yes, the dollar could go down, but let's not talk about the country's ending because the dollar is going to go down. And that's just where I've been at it. And so if you look at it, dollar goes up, dollar goes down. And you know who wouldn't mind the dollar going down? It's the president of the United States, because a weakening dollar means that our exports are cheaper and are more competitive. And he wants to see a revitalization of our manufacturing base. So that's why I think the dollar could go down. But I don't want to go with, let's all wring our hands that the country is ending with it. And I think the financial markets bore this out. The dollar could go down. Why isn't the stock market crashing? Why aren't interest rates soaring if the dollar is going down? Because they don't think it means the end of a reserve currency or the country's going to come apart in some kind of civil war at the end of American exceptionalism or something like that. It's the dollar's going down. And that's, don't read more into it than that.
Noted. Is there anything else that you'd like to share or that you feel is not receiving enough attention these days, Jim?
Well, if I was to go off onto one thing that I do think is not getting enough attention, and there might be a bit of a recency bias because I was looking at this today, is the state of the labor market. Now, a lot of people have been looking at job growth. I know that January's payroll growth was 130,000 jobs. A year ago, we were averaging 150,000 jobs a month. And now all of a sudden 130,000 jobs looks good, but a year ago that would have been below average. But prior to that number, we'd seen some negative payroll numbers and we've seen some very low numbers. And people have been getting very worried about the state of the jobs market. We're not creating as many jobs. And I've argued, and Jay Powell's actually made some of this argument too, and it strangely goes kind of unnoticed that he makes this argument, is that you need to look at what's called labor supply. What's the population growth of the United States? And the population growth of the United States, you could argue, in 2025 was the third lowest in American history. The only two times it was ever lower was 2021 with the COVID deaths and was 1918 with the Spanish flu. 20 million people died because of the Spanish flu at the end of World War I. And then 2025 was the third lowest. And there's an argument to be made that 2026 might be the lowest in American history. Why are we having no population growth? Two things. The fertility rate in the United States is falling. It is currently at around 1.7, meaning 1.7 children per woman. The replacement rate is 2.1, man, woman, 2.1, because unfortunately some children die. So we're not replacing ourselves fast enough. So where do we get our population growth? We get it from immigration, primarily undocumented immigration. What have we been doing in the last year or so? There's been effectively zero immigration into the country, and we've had levels of deportation, whether it's self-deportation or arrests that we've seen with deportation, and the population growth has been falling. Now, I'll make a quick comment about that. That's not good or bad. It is what it is. We have very low population growth because we don't have any more immigration. But what it does mean is that the labor supply, the break-even rate, how many jobs does the U.S. economy need to create? Might be very close to zero right now. So if we produce 10,000 jobs or 20,000 jobs, that's enough. If we produce 130,000 jobs, even though that would have been below average a year ago, that's a lot. But there's a number of people headlined by Chris Waller, a Federal Reserve governor, who in the January 28th meeting dissented because he wanted to cut rates. Primarily his argument was, look at the number of jobs we're creating, it's low. Oh yeah, I hear the supply story, but that doesn't matter. The number of jobs we're creating is low, and we need to stimulate the economy to get more jobs. I think, no, the number of jobs we're creating is appropriate given the growth of the country. And therefore, we need to get ready for, hey, we created 5,000 jobs this month. Pretty good number. No one's ready to say that yet. They want to say, hey, we've created 5,000 jobs. Panic. Fed's got to cut rates, emergency meeting, because we're not ready to accept. If you have no population growth, you don't need that many jobs. And that's exactly where we're at right now. That argument is probably a little bit more known now in the last month than it was, say, 90 days ago. But I still think it's not fully accepted by Wall Street and a lot of economists. But it will be eventually, I think, as we traverse through the rest of 26 and into 2027.
Yeah, that's certainly the first time that I've heard that, Jim. Trying to think of what else here. I think that's about it as far as. I mean, obviously, there's a million different topics to cover here, but I guess in light of time, how can people learn more about you, Jim, as well as get in touch with you in your firm?
Yeah, so a couple of things. I'm very active on social media at my original firm, Bianco Research. So you can look me up on Twitter X at Bianco Research, YouTube channel at Bianco Research, at Bianco Research or Jim Bianco on LinkedIn. We have a second business. We do manage a fixed income index. I'm originally a bond guy, so when I started doing this, I said I'm going to go to what I'm most comfortable with is in the bond market. It's called the Bianco Research Total Return Index. It's BTRINDX on Bloomberg, or it's BiancoAdvisors.com is the website about our index. And our partners at Wisdom Tree have an ETF that tracks our index. WTBN, Wisdom Tree Bianco Nancy is the ticker symbol. It's designed to be a total return fixed income index. If I went back to 4, 5, 6, 4% cash, 5% bonds, 6% stocks, this is for that 5 sleeve that I put this together for. And I'll just give you one quick pitch. Everybody knows that active management in equities has a hard time beating the index. Don't bother trying to uprun the index. Just by the S&P 500. It always outperforms. But in fixed income, it's active managers can outperform the benchmark indexes. Our actively managed index does, and WTBN that tracks us has since its founding, since its inception. And that's why we put this together. So if you're thinking about, fixed income investment, how to invest in fixed income, I would say active management is the way to go. Check out Bianco Advisors, check out WTBN to see if it fulfills the goals that you are looking for in your investments.
Jim, I appreciate you carving out the time to come on the show today and dispense your thoughts as it relates to what's going on. And really looking forward to reconnecting with you here before long to get your latest update.
Thank you. And I hope next time I'll be able to make it through without a horsey voice. Thank you.
Thanks for tuning in. And if you enjoyed the show, I encourage you to like, share, and follow if you found value in it. I always look forward to hearing your feedback and thoughts. And until next time, take care and be well.